Hey guys, Toby Mathis here, and today I want to talk about if I had to start over again, how would I pay zero taxes? If I had to do it all over again, starting from scratch, these are the, I'm going to say 5 strategies I'd use to eliminate my taxes legally. These are not loopholes, they're straight out of the tax code. And I've taught them to thousands of clients who have used them to wipe out 6, even 7 figures in taxes. If you want to pay zero in taxes or get very close, this is how you do it. Quite frankly, I'm fine paying taxes at lower rates like the 10%, 12%, even possibly the 22%. But above that, it starts to get painful. When you're getting hit federally at 32, 35, and 37%, plus employment taxes, plus state taxes, plus the net investment income tax, man, it gets painful. But I can relate to people, they need the money to grow their business, right? Their investments or whatever they have or to pay off debt, every little bit. So this is how you can eliminate taxes, how you can get to zero. Number 1, and this is first up, you got to set up the right business entities. It's all about structure. LLCs, S Corp, and even C corporations. Why? Because corporations let you shift income, split income, shrink your taxes legally. In some cases, eliminate certain types of taxes. For example, your self-employment tax by using an S Corp. It could absolutely eliminate that, especially if you have a passive partner in it or if you have high income. And I'm going to kind of start this off. I'm going to do a concept. I'm going to write this up, right? I want you to think about this. There's 4 Ds. Don't oftentimes go over this, but I want to go over this today. It's divide, depreciate, deduct, and delay. Divide, depreciate, deduct, and delay. And I'll go over what each one of those means. And let's go over what each one of these means real quick so that you get an idea. Divide, real simple, just means you find other taxpayers who get better tax treatment than you. For example, your kids might be in the 0% tax bracket and they might be doing stuff for your business. You want to pay them so that they pay 0% as opposed to you if you paid it to yourself and then covered their expenses. Like you bought their kids clothes or you're paying for school or whatever. You might be in the 24% plus tax bracket. So just paying them to help you may allow you to keep that extra big chunk of money. Or perhaps you use an HSA, a health savings account. It's 0% tax. You get a deduction on the contribution, so it's going to eliminate tax. You have 0% on the growth, and if you use the money for health, it's also 0%, right? That's a triple threat. You're dividing that income over there. Maybe you divide it with an entity like a C Corp, where it has expenses that you're not allowed to deduct, like the Augusta rule, health, medical, and dental expenses in a C Corp. The other Ds, the depreciate, deduct, and delay, they kind of go as follows. Depreciate really is, the way I always think of it, is the tax code allows us to offset income, take a write-off, with purchases of things like equipment or even real estate. Believe it or not, there's personal property aspects of real estate that you can do a cost seg and depreciate, usually over a useful life, but sometimes all at once. For example, in the recently passed One Big Beautiful Bill Act, we have back 100% bonus depreciation and a much higher amount for Section 179 equipment deduction, over $2 million. Meaning you could use this little thing, that depreciation, to create a massive deduction, which creates a big loss, even if you finance the purchase. In fact, even some leases. We'll get into that a little bit later. Deduct. What is deduction? Everybody's talking about deduct this, deduct that. It's simply writing off ordinary necessary business expenses. The right business entity allows you to do additional deductions, which equals less tax. For example, an S Corp will not allow you to write off health expenses, while a C corporation will. A corporation, an S or C, will allow you to write off the business use of your home, while a sole proprietorship won't, using the Augusta rule. How about delay? What is delay? Delay, this is a fancy way of saying paying taxes later. I'll gladly pay you Tuesday for a hamburger today, right? Think 401ks, DB plans, IRAs, installment sales. You're paying nothing now or very little now, but you're paying something later. This is a very common strategy. And for people who are building your wealth, this is a must. In fact, it's accepted that 401ks and similar retirement plans have made more millionaires than just about anything else. That's not a misstatement. You think about, I always use this fact that the number 3 category as far as professions for millionaires is teachers. Why? Because they almost all participate in a 401k. They do it consistently over time, and they end up becoming millionaires because of those savings. But those are the 4 Ds. And let's get back to the number 1 we were talking about, which is using the right entity, using the correct structure. If you use the right structure, you could pay your kids, you could rent your house to your business, or for high income folks, you could even push extra income into a C corporation where it's taxed at just 21%. So for example, if I'm earning $500,000 a year as a consultant and I run that income through a well-structured S Corp and C Corp, I could easily reduce my tax bill by a significant amount. Control the entity, control the tax. This is the foundation. Everything else stacks on top of this. For people starting out, the extra deductions can be the difference between a zero tax bill versus owing thousands of dollars. Those thousands are needed, so keep them. And I'll use another example. If you are a small business and you're getting hit with tax and you're like, gosh darn it, Toby, how do I eliminate some of it? Sometimes a simple strategy like making an S election, even on a business that's already set up as an LLC, that's a disregarded entity, maybe you're filing as a sole proprietorship, you can even make a late election and eliminate, in some cases, 5 figures of tax pretty simply just by eliminating a big chunk of the employment taxes and then using any other strategies, 401ks, IRAs, HSAs, we can oftentimes get it even lower. That's really important. Strategy number 2, if I was starting off all over again, this is probably where I'd go. I would be a real estate professional. I'd start by buying long-term rental properties. I love real estate. I own hundreds of properties. And I'd make sure that either me or my spouse is a real estate professional. Why? Because that unlocks one of the most powerful tools in the tax code. It's the ability to take passive losses from depreciation on real estate. So I mentioned the 100% bonus depreciation. It's usually about 30 to 40% of the value of a real estate purchase. So you buy a $2 million property, maybe you put nothing down. Maybe you put a really small amount down, but you're going to get, let's just say, $800,000 deduction in year 1. Maybe it's self-storage, or maybe it's something where there's a lot of land improvement. It could even be more, right? And you use that. That loss generally is passive, but if you're a real estate professional, it makes it non-passive. And then it can offset your active income like W-2 or your business income. There is a limitation, there's a cap on the amount, but it's very high, $600,000-700,000, right? So I've seen clients eliminate $200,000, even in some cases, even more, $500,000, because you can use that loss against all of those other businesses, active businesses, all the other real estate. You can literally eliminate 7 figures of tax using this if you meet the IRS hours test, which is 750 hours, more than 50% of your time spent on real estate, and you materially participate. This ends up being a game changer. It's called real estate professional status, and there's plenty of videos on my YouTube channel addressing it, but you should learn about it. If you want to talk about that one, just go down into the comments and write consult, and we'll reach out to you, and you can see whether you qualify. Third strategy, and this is if you don't qualify as a real estate professional, but you're still high income, you can use the short-term rental loophole strategy. You hear about this on TikTok, and all these people are out there parroting this stuff, but they don't really understand what it is, and they misspeak a lot of the time, and I'll talk about why. This is really if you don't qualify as a real estate professional, because even though short-term rentals sound like real estate, it's not. It's an active trade or business. It's called the short-term rental loophole because if your average stay is 7 days or less, and you materially participate in that business, it is a business. It's no different than if I opened up a pizza shop. My short-term rental that I materially participate. In other words, I have to be spending enough hours. It's generally 100 hours and more than anybody else, or I'm doing everything myself. So I have some clients where they buy a short-term rental at the end of the year. They're the only ones that rent it out, clean it, and do everything. And as a result, they don't even have an hour test. They materially participate because they did all the substantially all the participation was theirs. They get to take that loss against their other income. So your rental losses, this is no longer rental. This is non-passive business loss. Even, get this, even if you have a full-time job. This means you can offset your W-2 income, 1099 income, or your other business profit with depreciation from a cost segregation study on your Airbnb or VRBO. I've seen six-figure tax savings in year one, and the cash flow stays in your pocket. I have multiple clients that use this. The tax bill magically disappears, even for high-income folks. I have doctors who do it, highly paid consultants who do it, some realtors that do it, and yes, it can eliminate all of your taxes. This is a very powerful strategy if you're willing to do it. Again, if you want to see if you qualify or how to take advantage of it, consult down in the comments below. All right, strategy number 4. I've done videos just on this one strategy, which is the buy, borrow, die strategy. So let's talk about next level wealth building. I would absolutely use the buy, borrow, die strategy no matter what. Anybody who's wealthy or who has assets. So real estate, stocks, even Bitcoin. Here's how it works. Step 1, we buy appreciating assets, and these grow tax deferred. You don't pay taxes until you sell. Step 2, use a cost segregation to front load depreciation. So if you buy a $1 million building, you get 300, 400 grand in paper losses in year one. And this could rent out a bunch of your other real estate income. Step 3, instead of selling those assets and triggering taxes, you borrow against them. Tax-free loan. You don't have to pay taxes on loans. You refinance the real estate. You take a security-backed line of credit on your stocks. You borrow against your Bitcoin. No tax. None. Zero. You borrow against it and you use that money because loans aren't income. And then you do this long term because when you pass away, I hate always talking about this, but it's just the way of the world. When we pass away, our assets get a step up in basis. What that means is that from a tax standpoint, it's just like your heirs bought them the day you died, which means they owe zero tax on all that growth, even though you borrowed against it. That's why they call it buy, borrow, die. I buy the asset, let it grow, borrow against it. You know, think about Elon Musk, right? He's going to borrow against his Tesla stock. He's going to borrow against his assets, not pay a nickel in tax. When he passes away, that basis is going to step up. Now, somebody who's worth billions of dollars, they're going to have to worry about the estate tax. But they're not worried about capital gains. They're not worried about income tax, right? It's how the wealthy grow and preserve wealth tax-free. Strategy number 5. Most underused thing that I've seen in business. So many people don't understand this, but it's something that's really important. So I'm going to say last, but absolutely not least. If I was a high-earning business professional, so I was making money through my business, I would max out a defined benefit plan. Let me just give you what that means. A defined contribution plan is like when you define how much you put into it, that's like an IRA or a 401k. Hey, I could put this much money in every year as the employee contribution. I could put this much money as the employer. When you're doing a defined benefit, you're saying based off of what you're making, how much do I have to have in my retirement plan to continue to pay that out? There's a cap. It's like a little over $300,000, right? But it lets you defer a tremendous amount of money. In some cases, it's $300,000, $400,000, $500,000. We have clients that put $700,000 a year, tax deductible. I've seen folks that I've met that have done over $1 million in a single year. And when you layer in that solo 401k, profit sharing, wow, you can shelter hundreds of thousands of dollars in a year legally. And this is perfect for consultants, attorneys, real estate professionals, anyone making big money and thinking long term. Like, hey, I'm making too much money. I'm in the higher brackets. I'm getting killed. How do I do it? This is one of those strategies that works, a defined benefit plan. And the best part, you control how the funds are invested inside the plan. It doesn't leave your ecosystem. It's still there. You still control it. Now, I'm just going to say this. There's multiple powerful strategies that are big tax savers. We use about 45 different strategies here at my firm, at Anderson Business Advisors, to save clients money. And they really do work. I've been doing this for close to 30 years. And we've been using them. We have over 10,000 investors that we prepare tax returns for, and tens of thousands that follow me on YouTube and that are clients of my firm. Right. So while no single strategy, right? Maybe there's not a single strategy that's the bullet that takes out all your taxes. But when you stack them, use corporations, real estate professional status, other types of entities, short-term rentals. You've figured out how to use buy, borrow, die, using defined benefit plans. Maybe you're throwing in the 7702s. Maybe you're doing some oil and gas. You're doing things that legally reduce your taxes. Then you can legally eliminate taxes or come very, very close. Use the 4 Ds: divide, depreciate, deduct, delay, strategically to improve your tax position. I've done it. Thousands of our clients have done it. You could do it too. The tax code does not punish you. It guides you. And if you know how to read it, there's gold and then there are mountains. If you're really ready to build tax-free wealth, then what I would do is I would like this video. Let me know. Let the algorithm know that you like this type of stuff. Subscribe to my channel, because every week I'm putting more and more content out like this. So you got to just keep filling your brain. And if you really want to meet with somebody and say, hey, show me how to take advantage of these strategies, just type in consult in the comments. Just consult. Type it in there. We're going to send you a link. There's no cost for it. And as for you tax pros out there, these are just 5. I know there's like 45 in my back pocket, but these are 5 strategies that I would use to eliminate my taxes. What are your favorites? If you're a tax pro or you're somebody who knows taxes, leave it in the comments what you use, what you think I should be paying attention to. People are going to see it. But if you write like, I'm going to be a sovereign citizen, or I'm going to use some of these crazy trusts where they misuse it, and I'm going to block you, right? Don't do any of the illegal stuff. I want only legal tax strategies. If you say, just don't report it, sorry, you're gone. Sovereign citizen, gone. You can use the special trust that pays no tax, gone, right? But anybody else, put your comments below. Everybody could see it. So if you have other strategies that you'd say, hey, Toby, what about this? Put it in there and share it with the community. Thank you, guys. Let us help you keep more of what you earn. Subscribe and like. Thanks, guys.